Hi, I'm Sean Pat, CEO of Atala Tools and professor at UCLA, where I teach personal finance, entrepreneurship, and portfolio management. Today, I'm going to talk to you about options and the fundamentals behind them. Options, in many ways, are like fire. When you use fire correctly, it powers your city. When you use it incorrectly, it burns your city down. Options are the same way. When used correctly, they'll help you make a lot of money. When used incorrectly, you'll lose it all. Today, I'm going to cover option terminology, introduce you to call options, then we'll go over put options, and then a few other considerations that are important to note. Options are a two-sided contract. On one side, you have the option seller who sells the contract and is also called the writer. On the other side of the contract is the option buyer, who's buying the contract from the seller. However, in between them is the option clearing corp. They facilitate these transactions. The option buyer makes the payment to the option seller, who in return sells the option to the buyer and is called short the option, and the buyer who owns the option is considered long. The first important term of options is the strike price. This is the price at which the option holder can buy, in the case of a call, or sell, in the case of a put, the underlying asset the contract is based on. The next important term is the expiration date. This is the final date on which the option can be exercised. After this date, the option becomes worthless. Intrinsic value is the inherent profit within an option, assuming it is exercised immediately. So for a call option, your intrinsic value is going to be the maximum of either 0 or the difference between the current price and the strike price. For a put option, the intrinsic value is going to be the maximum of 0 or the difference between the strike price and the current price. The next important component of an option is the time value. This reflects the additional premium that investors are willing to pay for the possibility that the option could increase in value before its expiration. Time value decays, however, as the option gets closer to its expiration date. The last important term is the implied volatility. This is an estimation of the underlying asset's expected future volatility, and it's based on the market price of the option. A higher implied volatility translates to higher option premiums. Call options are a financial contract that give the holder or buyer the right, but not the obligation, to purchase an underlying asset at a predetermined price within a specified time frame. So for example, suppose Apple shares are trading for $152 per share. Instead of buying shares, you pay a $5 premium per share to buy a call option on Apple shares with a strike price at $150 that is set to expire in 1 month. The intrinsic value calculation shows that if Apple's stock price climbs to $160 by the end of the month, the intrinsic value would be 160 minus 150, or $10, representing the inherent profit in exercising or selling the option at that time. We like to show a payoff diagram to show the profit for the buyer of the call. So as the stock goes higher above the strike price, the buyer will make $1 per share. So the maximum gain for the buyer of the call is unlimited. because it depends on the rise of the underlying asset's price, which can go on forever. The maximum loss for the buyer of the call is just the premium paid, which is $5 in this example. On the other side of that contract, we show the seller's payoff diagram, which is the exact inverse of the buyer's payoff diagram. The maximum gain for the seller is the premium paid, the $5 per share. The maximum loss for the seller, however, is unlimited because it depends on that same underlying asset price, which can go on forever. The other kind of options are put options. Put options are a financial contract that gives the holder or buyer the right without the obligation to sell an underlying asset at a predetermined price within a designated time frame. So, for example, suppose Tesla shares are trading for $195 per share. Instead of shorting shares, you pay a $10 premium per share to buy a put option on Tesla shares with a strike price of $200 set to expire in 1 month. The intrinsic value calculation for this put option will show that if the price of Tesla shares falls to $180 within that month, the intrinsic value is $200 minus $180 or $20 per share, representing the inherent profit in exercising or selling the option at that time. We can also show the payoff diagram for this put option, and we'll start with the buyer's diagram. So the buyer of the put will make more money as the stock goes towards zero, and the maximum gain for the buyer is going to be the strike price minus the premium, $200 minus $10 or $190 in a scenario where Tesla were to go to $0 per share. Very unlikely. The maximum loss for the buyer is the premium paid, $10 per share. Just like with the call option, the seller's payoff diagram is going to be the inverse of the buyer's payoff diagram, where the maximum gain for the seller is the premium paid, or $10 per share, and the maximum loss for the seller is the strike price minus the premium, or $190 per share. A few other considerations for options you should be aware of is the distinction between American and European options. European options differ from American options in that they can only be exercised at the expiration date, not before. The next term I'll cover is the volatility index, or VIX, which is a widely followed number. The VIX, however, is a derived number that comes from price inputs of specific contracts related to the S&P 500 index. They provide a measure of market risk and investor sentiment, and when this number gets higher, it shows there's more concern and fear. So this is also known as the fear gauge. The next consideration to be aware of is called put-call parity. So this concept is built on the law of one price. This states that identical goods should sell for the same price in a frictionless market. This holds true with many liquid options, but certainly breaks down when you get stocks with high borrowing costs too short. So to summarize the key option fundamentals, options are a two-sided contract that give the holder or buyer the right, but not the obligation, to buy when it's a call or sell if it's a put, an asset at a predetermined price within a specified time frame. Options are leverage, so be careful because it amplifies potential gains and losses. They require careful and strategic use. So consult with a financial advisor if you want optimal decision making. They have experience. You want to continue on your own? Check out Atala Tools college textbook on our website, and you can learn more about options and strategic uses of them. So remember, investing is hard, but Atala Tools is here to help you every step of the way.